Welcome back to the channel. If you're trying to get a debt consolidation loan with bad credit, let me first give you an overview here. First things first. Debt consolidation loans are not for everyone, so you want to consider the pros and cons before you actually you start doing anything. You got to ask yourself some questions about your debt payoff strategy, your financial situation too. Here are the pros and cons here. The pros. A debt consolidation loan may offer lower interest rate than what you are currently paying. It can reduce the size and number of monthly payments, and it could improve your credit score if your credit utilization goes down. This is really important. So that's for the pros. What about the cons? Well, getting a good APR can be difficult with bad credit. You may not qualify for a large enough loan to pay off all of your debts, and new hard inquiries may actually negatively impact an already bad credit score. So that's the situation I want you to really think about before you get yourself into a debt consolidation loan program. Okay. Now, let me quickly remind you that this type of loan is used to roll multiple debts into a new one, ideally with a lower interest rate than you are currently paying. And this would also reduce the number of debt payments you make each month and could even shorten the amount of time you are repaying debt. And so personal loans for debt consolidation are typically unsecured, which means what? They do not require collateral. Boss, what happened here is that the lender will rely heavily on your credit score and DTI. The DTI ratio is important because they will actually use that criteria to determine your eligibility and interest rates. So you got to have a clear idea of what you're getting yourself into before you start thinking about getting a debt consolidation loan with bad credit. And so, but it's a loan that's really great. It has a lot of benefits. For example, you have fixed payments. Okay, so most debt consolidation loans have fixed interest rates with a set repayment term, and your monthly payments will be the same every single month, unlike monthly payments on credit cards. And a predictable monthly payment is a lot easier to work with when it comes to juggling multiple payments and actually solidifying your budget. You also could have lower interest rates. Okay, it's generally only wise to get a debt consolidation loan if you get a better interest rate than what you are currently paying. And also, this is also great for your finances. You have simplified finances because, again, the debt consolidation loans makes things a lot easier for you by rolling multiple monthly payments into one. So the bottom line is what? You got to have a clear idea of what a debt consolidation loan is first before you start getting into a program. Now, let me give you the steps you need to follow to get your debt consolidation loan with bad credit. Step number 1, you need to check and monitor your credit score. The thing is that a lot of folks believe they have bad credit, but when you really check your credit score, you realize, things ain't really that bad. I mean, I thought I was under 400. I thought I was under 500. But when I checked, I realized, things are really, I'm like around 525 or 600. You never know, boss. You never know. And the thing is, when we talk about you checking and monitoring your credit score, because there are two things here. You have to first check your credit score, and then you have to monitor it. So the initial check is not just one credit reporting agency. A lot of folks just love, I love my TransUnion, I love my Equifax, I love my Experian. But boss, you're making a big mistake here. The initial check, you want to check all three. In other words, what you want to do is you want to go to a site like annualcreditreport.com. It's free. You don't have nothing to pay, and you want to actually check those free credit reporting agencies, because if there is a discrepancy, you can actually spot it, and you can actually see why there is a discrepancy. People say, well, from one credit reporting agency to another, you might have a few points of difference. Yes, if you have 10 points here and there, 20 points here and there, it's fine. What I'm trying to say here is that if your Equifax, for example, shows that you are at 520, your Experian shows that you are 545, and your TransUnion shows that you are around 510 or 500, that's within reasonable margins. But if your Equifax were to say that you are at 500 and your TransUnion is saying that you are at 600 or 650, there's a huge chasm, there's a huge gap, and this actually will call for more scrutiny. So that's for checking the credit score. Now, after you check your credit score initially, you have to have a routine where you are constantly monitoring your score. And we tell our viewers, you have to do this every week or every 2 weeks, especially if you're trying to get a debt consolidation loan with bad credit. It's important to actually check your credit score routinely. You might be saying, well, I don't have time. This is a lot of work, blah, 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 blah. It's not a lot of work. It takes 1 minute, 2 minutes. Once you have access to the right service and you can get the service for free, it only takes 2 minutes. Once, let's say a Saturday afternoon, you just look at your finances and you see, if you have been making progress or whatever. So, but it's important to monitor your credit score. Now, if you don't want to do it weekly, you can do it bi-weekly, every 2 weeks. That's fine too. But you got to be in a situation where you are monitoring your credit score so that you can get the best rates when it comes to your debt consolidation loan with poor credit. Step number 2, you want to research lenders in your credit band. You have to understand, if you have poor credit, the amount of lenders willing to extend you a loan will be limited. But it doesn't mean that you are out of options, okay? So you want to check your minimum credit score requirements, but make sure that you shop around. Very important, boss. You want to shop around. It's always a great idea to accept the multiple offers, especially if they want to do a soft pull. Okay, you always want to go for the soft pull because you are trying to preserve your FICO score, which is already bad anyway. So if you want to preserve your credit score, you want to go for a soft pull, and so you want to shop around. You want to make sure that you go with online lenders. In this space, it's just a lot easier to go with online lenders because they have the resources and technology to make sure that you have the right loan. Let's quickly look around at some of those lenders here. You have Avant. Avant is great for fast money. You were speaking about a loan amount, a debt consolidation loan that goes from $2,000 to $35,000, okay? And they do charge you an origination fee up to 4.75%, and the APR oscillates from 10% to 36%. And then you have Happy Money. Happy Money is great for consolidating credit card debts. And here you have an APR that goes from 8% to 30%, the loan length 24 and 60 months, and the loan amount $5,000 to $40,000. And they do charge you an origination fee that goes from 0% to 5%. It depends on the transaction. You have Peer Form, and this is great for peer-to-peer lending in terms of your debt consolidation loan. You are looking at an APR that ranges from 6% to 30%. You have a loan length that actually is either 36 or 60 months, and the loan amount $4,000 to $25,000, and they do charge you an origination fee that goes from 1% to 5%. Then you have a lending club, which is great for low borrowing amounts. They will actually grant you a loan that goes from $1,000 to $40,000. The origination fee here is 3% to 6%. We are looking at an APR that ranges from 8.30% to 36%, and the loan length 36 to 60 months. And the last lender I want to share with you here is the Lending Point. So Lending Point is great for low credit score. If you have a really low dirt poor credit, you might want to think about Lending Point. So here they will take credit score that go all the way to 500. The APR goes from 8% to 36%, loan length 24 to 72 months. So here we are looking at 2 years to 6 years, and the loan amount $2,000 to $36,500. Step number 3, boss, you want to apply for pre-qualification. I actually did this before. I actually spoke about this before, but it has to be reflexive and it has to be immediate. What I'm trying to say here is pre-qualification involves a soft credit inquiry, so you can check your eligibility and terms you may be offered without affecting your credit score. If you have bad credit, even losing a few points from a hard credit inquiry could affect your chances of getting a loan. What I want to say here is a soft pull is not a guarantee. I mean, a pre-qualification is not a guarantee of approval, okay? But it gives you an idea. You have a clear idea of what you might qualify for. And the lender and all the lenders that I just gave you, from a Lending Point to Lending Club to Avant to Peerform, they do have a soft pull tool embedded on the website, so they will never do a hard pull right away. They'll first do a soft pull to make sure that you actually can pre-qualify. Now, what does it mean to pre-qualify for a personal debt consolidation loan? When you go through the process of pre-qualifying for a personal debt consolidation loan, the lender essentially pre-screens you before you complete an application, and the process informs you if you are likely to be approved and what the terms will probably be if your full application is successful. So they will ask you for a couple of information here. They'll ask for income, current outstanding debt, desired loan amount, the desired loan term, the credit score range, and the reason for borrowing. Okay, and if you want to, one thing for sure, once you are qualified, once you are pre-qualified, please review those pre-qualified offers thoroughly. We're speaking about, you want to review interest rates and fees. You want to check the APRs and upfront fees across your loan options to weigh the cost of each loan. Remember, some of those lenders, they do charge you an origination fee. Okay, you want to also consider the loan terms. Generally, the shorter your loan term, the less interest you pay over time. Longer loan terms may offer a lower monthly payments, but you have to pay more interest overall. So before borrowing, you have to decide which matters more: lower monthly payments or long-term savings. Check the funding time frame. If you need money quickly, the lender that offers next day or same week funding could move to the top of your list. Also look for borrower perks. Some lenders offer borrower benefits like an interest rate discount if you sign up for autopay, or payment relief options if you lose your job and face financial hardship. So these loan features could end up being a deciding factor if you are waiting to similar loan options. Step number 4, you want to formally apply for the loan, boss. So you've done your research, you actually have calculated everything, you actually have thought about the loan terms, the interest rates and fees, the funding time frame, the borrower perks, if any. Now it's about time you actually apply for the loan. Now remember, in the like 5 minutes ago, I was just talking to you about a soft pull. Now, if you have to formally apply for a loan, be ready to actually undergo a hard credit inquiry. And this will slightly but temporarily impact your credit score. So when you reach this stage of the application process, be prepared with documents that show your ability to repay debt, such as tax returns and pay stubs. Some lenders will actually be okay if you show them your bank statements so they can see your cash inflows and cash outflows, or some can even ask you for your 1099s also, or your financial statements, so your PFS, your personal financial statements. Now, the one thing you need to understand is if you want to qualify for a debt consolidation loan, every lender sets their requirements for borrowers looking for debt consolidation loans. You should be at least 18 years of age and not be involved in bankruptcy or foreclosure proceedings. And every lender will also look at your credit score, income, and debt to income ratio to determine how capable you are of repaying your loan. DTI plays an important role here. And one thing I want to say here is that, I mean, this is logic. The lower your credit score, the higher your interest rate, since borrowers with bad credit scores pose an elevated risk of defaulting to the lender. And your DTI ratio is also important. And more lenders want you to be below 45%. And for us, 45% is even higher. We want you to be you want to be at 30% or lower. Okay, and this is really important because the lender is looking at your ability to repay the loan. So because the higher your DTI, the lender might think, rightly so, that you are overextended and could have trouble making timely payments. And you could also just get approved if you have a poor credit score, but you can be approved at a higher interest rate to actually hedge against the risk of a default for the lender. So long story short, when we talk about formally applying for the loan, remember, if you are actually applying at a bank, you can also, a bank or credit union, you can go to a branch to apply there. But if you're applying for an online debt consolidation loan, you can just do things over the phone. Step number 5, you want to use the loan funds to pay off other debts. One thing that you need to understand here is that If you are approved, the lender will typically deposit the money into your banking account within a few days. You can use this money to pay off all types of debts like credit cards and payday loans. And so debt consolidation is worth it for certain situations and not worth it in others. Let's talk about when debt consolidation is a smart move. You have to understand, success with a consolidation strategy requires the following. Your monthly debt payments, including your rent or mortgage, do not exceed 50% of your monthly gross income. Your credit is good enough to qualify for a credit card with a 0% interest period or low interest debt consolidation loan. Your cash flow consistently covers payment towards your debt. If you choose a consolidation loan, you can pay it off within 5 years. 5 years, this is really what's important. Okay. Now, when is debt consolidation not worth it? Consolidation is not a silver bullet for debt problems because it does not address excessive spending habits that create debt in the first place. It's also not the solution if you are overwhelmed by debt and have no hope of paying it off, even with reduced payments. If your debt load is small, you can pay it off within, say, 6 months to a year at your current pace, and you would save only a negligible amount by consolidating to not bother. Really, it's not worth it, especially if the lender is charging you a 1 to 7% origination fee. Okay, try a do-it-yourself debt payoff method instead, such as the debt snowball or debt avalanche, which we have covered this on other shows, and so it's important. And if the total of your debt is more than half your income, you also need to think about maybe seeking debt relief. Okay, one thing I want to say here is that when we speak about using the loan funds to pay off other debts, remember there are some lenders who will actually pay your various other lenders. They will pay them directly. In other words, they're not going to send you the money and asking you to actually repay them. No, they will do the payment right away. Either way, make sure that you are responsible with the payment. You have to actually follow up with those lenders. Okay, either you send it yourself or have the lender send the amount. Make sure that you contact your prior lenders to make sure that your balance is zero and that they will report the zero balance to the credit bureaus. Let me give you, I want to talk a little bit about the approach that you really need to follow here. And it's really important to have the right approach here. And where do you actually get a debt consolidation loan with bad credit? There are a lot of options when it comes to that. Now, obviously, I've given you online lenders, but you can actually get this type of loan at various places, at various financial institutions. For example, credit unions and local banks. Now, local banks and credit unions, they will typically check your credit when you apply for a personal loan, just like any other lender. Yet this local financial institutions may be willing to offer you more leeway if your credit is not in great shape, particularly if you have a positive relationship with them. This is why we always mention on this show the importance of MPR, multi-product relationship, the importance of having a solid banking relationship with the local financial institutions, including the credit unions. Very important. So you can also check with online lenders. I spoke about those already. So the cool thing about online lenders is that they are fast. Okay, they're more expensive sometimes, but they do offer you the ability to pre-qualify for the loan. You can also get this type of loan at national banks. I'm talking about the Chase of the world, the Bank of America, the Wells Fargo, the Citibank, okay, or even the regional banks such as PNC, US Bank, TD, and Ameritrade. You have also you have Truist, okay, and you have Fifth Third. So what I'm trying to, of course, if you have a relationship with it, you got to have a relationship with them first before you can qualify for a debt consolidation loan, because banks by nature are risk averse. And the thing here is that if you have a bad credit, this is like this actually poses an elevated risk to regular banks, and they don't want that kind of profile. But if you have a relationship with them, you can parlay that positive relationship into a loan. And so it's important, though, if you want to manage your debt consolidation loan, please create a budget, okay? Because it doesn't matter where you get the loan. Once you get the loan, you need to find ways to manage it. Create a budget, pay pay off all your debts immediately. In other words, make sure the other debts are paid off immediately. You want to set up automatic payments, okay? And you want to resolve any spending issues, because the whole thing is, we get in debt. All of us get in debt mostly because of overspending. You are living beyond your means. So you got to really fix the root cause, because otherwise it's just going to be a temporary fix, and you don't want that. Let me give you a few pro tips before. When we talk about getting a debt consolidation loan with bad credit, make sure that you have a backup plan, because things will not go your way all the time. So what do you actually do if you're not approved? Now, not every borrower is a good candidate for a debt consolidation loan. In particular, it's possible that consumers with bad credit may not qualify for a loan at all. If you don't have the income or credit score required for a debt consolidation loan, consider taking the following steps before you formally apply. So look for ways to improve your credit score, okay? So if you have bad credit and can delay taking out a loan, making on-time payments and lowering your credit utilization ratio are among the steps you can take to boost your credit score today. And possibly opening up an additional lender option, constellation of options, okay? And it's important to think that you can always check and monitor your credit score for free on various platforms, including the Lending Tree app. You can also go to Credit Karma has something similar. You have Nerd Wallet, you have Wallet Hub, you have a constellation of different players that allow you to actually see your credit score and report for free. Okay, consider a cosigner. Yeah. Bad credit borrower may consider enlisting the help of a friend or family member who has good credit and will be willing to co-sign on a debt consolidation loan. Remember, a co-signer is a borrower who takes out a loan with you and will be responsible for paying back the debt consolidation loan if you were unable to make payments. Depending on the lender, this could be your only chance of lending a loan, so make sure to research lenders that allow co-signers, as not all do. You want to research secure loans. Now, consider a secure loan, a secure personal loan, because this could help you also boost your FICO score. Debt consolidation loans are typically unsecured, but you may be able to find a secure personal loan that's backed by collateral. And secure personal loans are more attainable for borrowers with bad credit, and it may be possible to get a lower APR on a loan that is secure compared to a loan that is unsecured. However, you should exercise caution when taking out a secure personal loan here, okay? Because some secure loans may use your auto title as collateral, which means that you could lose your car if you fail to repay the loan. A better option may be to find a personal loan that is secured by your savings account so that you don't risk losing an owned asset like your car. And also check with your local credit union. It's always better to research credit unions, because credit unions are by definition non-profits, member-owned financial institutions, and they may be more willing to work with members who have bad credit when it comes to debt consolidation. Here is a bonus for you before I close today's conversation. It's really important when you think about debt consolidation loans, especially with bad credit. Remember, there are alternatives to a debt consolidation loan. And this may not be the best option for everyone. So if you can't qualify for a debt consolidation loan with a lower interest rate than you are currently paying, you might want to consider some of the alternatives that we're going to give you. Now, you have credit counseling, for example. So a credit counseling agency can help by acting as a middleman between you and your creditors. And a credit counselor can also help you understand your credit report and suggest steps for improving your credit score and achieving financial stability. And some credit counseling agencies even offer limited services for free. You have do-it-yourself fixes, okay? And so there are a few ways to alter your financial plan without involving third parties. So to start tackling your debt, you can overhaul your budget. You can renegotiate the terms of your debt. You can ask for a due date adjustment. Yeah, this is totally possible. You can also consider a debt management plan. Again, we're speaking here about alternatives to a debt consolidation loan. So you can think about debt settlement. So debt settlements goes one step further than debt management. Basically, when we speak about debt management, so debt management helps you actually administer your debt, your current debt. Okay, And going through this process typically results in a notation on your credit report that you are on a debt management plan. Though the notation will not impact your credit score, new lenders may be hesitant to offer you new lines of credit. And so you have debt settlements. Debt settlements actually goes one step further than debt management, because debt settlement companies like let's say a National Debt Relief and Freedom Debt Relief work with you to settle your debt for less than what you owe. And the caveat is that you typically need to pay enough into an account with the debt settlement company before it will begin negotiations with your creditors, often at the expense of making your regular monthly payments, forcing you to default. Okay, and so if you default on your debts, it could damage your credit score even further, which can make a long time. We can actually take a long time to rebuild. So it's actually a catch-22. You have to be really clear about what you want. And if you are currently in that situation, please, you can just drop us a comment below. We'll answer you and give you a more specified answer. And also think about your home equity. If you have equity in your home, you can actually use it to consolidate debt. You can think about bankruptcy also, which is, even though we don't want you to go that route, but hey, listen, I'm just giving you the possibilities out there. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about how to get a debt consolidation loan with bad credit. I give you an overview and the steps here. Check and monitor your credit score. Research lenders in your credit band. Apply for pre-qualification. Formally apply for the loan and use the loan funds to pay off other debts. I give you some information in the approach, and the pro tips and the bonus. Thank you so much for your attention. I really appreciate it. God bless you. I'll see you next time. But until then, remember, stay marvelous.